The problem with 70% of the people is they're constantly only depending on a price. Like you're not marketing. You're just simply a cash mark. You're essentially a cash marketer, and that's all you are.
Hey, welcome to Hedge Heads, where we discuss the commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. Well, no one knows where the market's going. We're not afraid to share some ideas. I'm Ryan Tunkseth. He's John Prishman. Well, John, we have had a whole week of summer here. If crops are growing as fast as my grass is, there might be a reason prices are going down.
I think you get a lawn chair out, grab 3 beers, mark a stick with the top of the leaves with a stick, and I think after those 3 beers that it would be well above the stick because it's growing that fast here anyway.
Is that true across the country? I have not paid attention to the weather systems. I know the east was dry. I know they did get rain. But...
Yes. I think this is where it accelerates, and it's noticeable driving in the morning past the field, and then after work driving past the fields, they look different. So, and I would say that's pretty typical in any year. It always you get the early spring stuff, early summer stuff where it's uneven, it's behind, it's this, it's that, and then all of a sudden one day it shoots up like a missile, and then it's like, oh, it's a little tougher than I thought it was. We're definitely in that phase now where people are maybe surprised about how good it looks, but it really shouldn't be a surprise. Kind of happens every year, and the genetics get better every year. I would say Minnesota is probably the state with the most complaints I hear. I cover a pretty wide swath. I've heard nothing from North Dakota, which is unusual. They must be busy spraying their record crop. I don't know what's going on there, but I haven't heard anything bad, and anybody that's driven through there has nothing but good things to say. But pretty quiet on the North Dakota guys. That's always a sign that it's big, especially for wheat. South Dakota, very, very quiet, but again, quiet generally equals busy, making sure that you're getting max yield out there, doing everything you can with and no complaints. I mean, that's generally a good sign. I feel like that a lot of people underestimate their yield because just psychologically they don't want to be disappointed financially. They start doing the math in their head, and you don't want these gigantic numbers and start, buying new washing machines and buying new farm equipment, spending the money already, and then it doesn't live up to those numbers. So I do find that people tend to really underestimate it, and I think it's just a self-defense mechanism more than anything else. They don't want to go with this high watermark and then be disappointed. They'd rather be at 135 for their corn and then be surprised by 205. It just feels better, than to go, this could be 220. This could be the year I've been looking for, maybe 230, and then start doing the math, and then it's 205. It seems really disappointing. So people tend to be really defensive with their yield, and that's why the surprise is higher a lot of times more than lower. And historically, the disappointing yields, without a doubt, have been from too wet and cool all summer long. And you hear the groans the entire summer, and then you start hearing in harvest low test weight. And then you start hearing that widespread. It tends to be years where that yield really doesn't live up to the hype. Other years where yield might be a little disappointing is going to be the really hot and dry nights. Or not even dry, just hot nights where the pollination, where it really pushes it, and basically the plant grows too fast to get that maximum yield being pushed at night. So those are the two where sometimes it does live up to the idea that this isn't as good as we think. You're not hearing too much of that other than the usual defense of, I don't think this is going to be that great, probably farm average. So when I hear farm average in mid-July, boy, it's got potential to be a monster this year.
Well, I think that leads us into what is the title of our show, and that's hedging. And we haven't done a deep dive into hedging really ever. We've talked a lot of hedging. We've talked hedging strategies, but when you look at a year like this year, and now we're on the downward swing of prices. People are looking for bottoms, but there was lots of opportunities to hedge. There were ways to hedge. talk about hedging in general. Like, I mean, you're protecting your price, right? It's a way of insurance, but what can we look back at some past stuff now this year and how this year played out?
The last 2 years are perfect examples to go through. Last year was probably one of the hardest hedging years that I've ever seen. You had a lot of early heat, a lot of summer heat, and not a lot of rain. Very difficult to determine what was going to be the yield. We just hadn't seen a year like that for a long time. And it's hard to hedge above the bushels that you are exposed to. So if you overhedge at the elevator and you can't come up with those bushels, you got to come up with a difference. But there's easy ways to prevent that with options. And guys, I find are very black and white with their hedging. It's either hedged or unhedged, and they don't use the gray areas that you really should to your advantage. Last year would have been a great year for buying options because you didn't know if it was going to explode higher or if it was going to be a record crop and plummet. You just couldn't know. Nobody could know. So options would have been a great way to hedge last year. They were pretty expensive though. They weren't, I wouldn't call it dirt cheap. The $5 puts last year, the cheapest they got were 8.5 cents. I know because guys got them, and that would have been on the summer spike. And I think it hit 8.5 a few different times. And then the $6 puts, I'm going to guess were somewhere near 35 cents. I don't know, probably maybe 45 cents. So you could have guaranteed yourself $5.50 probably for 50 cents, worst case scenario. But the yield was the one that was tough to figure out last year. You couldn't know what you could hedge because you didn't know what you're going to have on your farm. So if you weren't familiar with options or you weren't familiar with hedging, it was one of the hardest hedging years, and that's why I say it was. And I use that term loosely. Guys, feel like they're hedging if they're selling it at the elevator, which it is. It's just your first basic level of hedging. But then this year was very easy. I mean, the main problem that I saw was guys didn't like the price. So I'm not going to hedge. Why hedge a price that isn't profitable? And that's a good argument, except for, a 475 corn doesn't work for you. I hope 375 corn works for you. So, I mean, I understand why it didn't happen. But when you look at how cheap the puts were this year and for how long they were, take March puts, for example, for corn, $5 puts were 34 cents for days. So essentially you can guarantee yourself 466 worst case scenario futures all the way through the third week in February for 34 cents, 35 with commission, or 34 and a half here, because our commissions are low. But you could guarantee yourself the worst case scenario for 465 all the way through, essentially February. And you got to see all the weather. You got to see everything. But if it went to $6, you also got that. So this is one of the easiest years I've seen to hedge, and probably the least amount of hedging I've seen. It just doesn't get any easier than this. And guys chose to save that 35 cents to see what happened. And it didn't turn out very good, and it's still not turning out very good. We'll see where we are in February. But it was easy. It just was very little money for an extraordinary amount of time, and you had your upside wide open, and you had your price guarantees not very far away from where the market was most of the springtime. If you didn't do well this year, and I'm not saying I did it perfect. Yeah, it's a two-way street. Guys need to call, and a guy needs to come up with a plan, and you need to execute it. But it doesn't get any easier than it was this year. I mean, it really doesn't. Because if you didn't even contemplate it, then you really need to work on what it was. The weather wasn't complicated. The options were as cheap as they're ever going to get, for that amount of time. And it wasn't the greatest price, and that was really the only negative that it was. But if it's in a negative market, like when you looked at the USDA's numbers rolling into spring, there were some of the worst that we've seen, basically in the last 10 years. It wasn't as bad as a trade war. That was worse, but that was a different situation. But these were terrible numbers. I mean, we started with, and I don't think that people were paying attention to them at all. These are USDA numbers I'm talking about.
Do you think the lower prices or prices farmers don't want to see makes easier hedging, or are there years where the price is bad and it's still hard to hedge.
I think that they spend money on a lot of stuff, and they don't want to spend money for this kind of stuff. From what I gather, in their mind, they're giving up 35 cents of what they can get on top of what the price is going to be, and they're not interested in it. And that's not what that hedging is at all. This is no margins because you're buying a put. You're not even giving up any of the bottom line necessarily because the price wasn't even $5. I was buying in the money puts, or suggesting to anyways. So the price is more like $4.75, would you say, for an average, So the reason why you buy an in the money put would be because you're trying to get away from paying all that pure premium. So when they price an option, it has to do with volatility, the Black-Scholes model, and time. And kind of attitude of the market. So you mix that in, and it was as cheap as you're going to see stuff. So when you buy in the money, you're trying to get away from some of that premium. So let's just say $4.75 was 30 cents. You buy $5 for 35. You have intrinsic value, money that it's already worth, which would have been $5 minus $4.75, 25 cents of intrinsic value. You pay 34 cents, and then all of a sudden you're only paying 10 to 15 cents of pure premium for that option. And we probably, for guys that don't, that are beginners, maybe didn't follow that. But you're trying to get away from paying so much premium for an at the money put by buying in the money. You would do this in a market that you felt was very bearish and was likely to continue down. You would not do it in a market that you thought would have a significant upside. You'd spend the least amount of premium as you could, and you certainly wouldn't buy in the money and spend even more money. So it's a strategy that you employ to get away from some of the premium to at the money, but yet you're bearish, but still you want to remain hopeful with the upside open. So this strategy costs 34 cents, guaranteed you 465 futures in March, worst case scenario for your floor, but yet you had your upside wide open. So this is where a smarter hedger is going to get away from the guys that just have that black and white. They didn't want to pull the trigger because it wasn't a good enough price. But that's not what this strategy did. All it did is allow you to see what the summer weather was. And if it exploded to $6, $7, you got that, or at least a chance at that. And if it didn't, you had your safety net below you. And now that's looking like a really smart idea. Ultimately, we'll see how it turns out. The price could go down to 380 in next month. I have no idea. Let's just say for math, we go to 380. You can take your put off, and then if it goes back up to 460 later on, you get that put money and you get the 460. So there's a million shades of gray, and that's a whole nother episode. How to manage the hedge once it's on and profitable, which is, in my opinion, by far the hardest thing to do. And I messed that up this year. For those guys that did buy the $5 puts that are listening, I acknowledge that the cute wiggling and waggling that we thought we were going to do did not work. So in my opinion, that's always the hardest thing to do, is to do that. Try to figure out where to get out of your hedge. But again, that's a whole nother episode. So back to where we started.
Actually, I'm going to take you back one more step too, just a deeper explanation wise. You talked about last year being hard because you didn't know the yield. It was so up in the air. What percent, if you're working with a guy and talking about marketing, like what percentage of their expected yield are you recommending hedge? I mean, you're never hedging 100% of what you expect to produce, are you? Or
it really depends on the guy. You're going to get guys that are beyond aggressive, and there's going to be guys that saw this bear coming that not only hedged 24, they hedged 25. And then if they're really advanced, they might have used 24 for 25, which is not recommended. You want to use the crop year that you're hedging. But guys that know spreads and know that 24 is going to fall a lot more than 25 might even use 24 to pick up additional money. Again, absolutely not a recommendation. Using different crop years to hedge that. But no, there's going to be guys that do years out, at a time, and 100% of maybe insured bushels, I think, is where the line's drawn a lot of times on what they're insured for. But it really depends on the guy. Some guys are only comfortable with 10% going into summer. Some guys have a set plan at certain prices, and it's going to be high percentages. Each farm's an individual plan. I would definitely say what I would recommend to do but every guy's really different. I just think that people are subscribed to the information they want to hear, and I think people are being told that it's going to go up all the time now because it sells in various ways. I saw a chart today on Twitter, perfect example of the world ending stocks in corn. If you take China away, yeah, I mean that's cherry picking. It's like this isn't 2020 when China had a huge amount on the books, and then we had a lot on the books. And then China started buying ours every day, and they actually didn't have the corn they said they had. But it's it's very misleading. You can make any chart look bullish if you want. So if you look at without China, our ending stocks, they aren't very high. That is true, but are the markets going to trade that? No, they're not going to trade that. You're going to have to see that demand come for that to be overridden. In my opinion, that's my kind of overriding the USDA's numbers. When you see the demand clear out the commercial channels, then you have a chance to rally at any time, irregardless of what the USDA's numbers are. Well, and we're just not seeing that.
Like the baseball stats that we've talked about on previous shows, where on the third Sunday when the other team's wearing red socks.
Yep.
And
unfortunately,
he throws a fastball.
It's gotten into commodities. It's steered away from there a long time. People would see a story be 2 days old and they didn't really care. Now it's hitting their phone. It's hitting your email in real time with great, all this important advice, which really essentially from what I witnessed is basically everybody telling this stuff, everybody it's going to go up for this reason or that reason or flooding. You can always find a reason, and it sells really well, probably, really well. And that's why it feeds on itself. More subscribers, tell them what they want to hear, but it just seems to have run rampant. Like if you just looked at what they used to look at, the USDA's numbers coming into spring, they were terrible. The outlook was terrible. The spring weather wasn't perfect, but it wasn't bad either in any way, shape, or form. But even when that was happening, you remember the planting delays that were never delays. Somehow everybody got in their mind there was planting delays, and we were running right ahead of the 5-year average. But then back to what I was saying, you'd have the guy, oh, what about 2019? It's throwing the average way off. These guys are way off. This is way delayed. And there's always those guys that are saying that. The problem is a lot of people are subscribing to these guys now. They'll cherry pick everything. They'll even right now you hear this corn doesn't exist on farms. They couldn't possibly know that. And it doesn't even matter. That'll show up later. They're going to trade what the USDA says. And I don't know how we got so far away from that. The funds didn't, and they're making money. I mean, and that's the simple truth of what happened this year.
That's my tweet of the day. I saw a corn bin got blown over somewhere. It was a picture of a bin that got blown over in a storm, and they said, must have been the only empty bin on a farm, according to the USDA.
Yeah, the social media has not helped marketing. I can tell you that. This wouldn't have happened. What happened this year with corn, everybody storing into one of the largest carryovers ever, would have never happened 3 years ago. Like, there would have been a lot more fear, a lot more marketing along the way. To see what happened where we had 2.1 billion bushels carried over, and then to see people store as much as they did into the teeth of the bear. Of course we didn't know what the weather is, and I don't claim to say that I did, but once the weather kind of turned here, there's still a lot of bushels out there. Why would you store into one of the biggest carryovers we've ever seen in corn? Well, obviously they didn't believe it because of what they were hearing. My advice is to believe the USDA's numbers, and if you don't, there are strategies that you can do even right now. Like you can bull spread corn in the back end. You can buy calls. There's a million things you can do. But I just don't understand why people fight it so much, because that's what the hedging's for. If it's these numbers, you got to deal with it. You can make the debate or the argument that we need to change the whole program. And I won't argue against that at all. Like how everything's counted, how it's reported, how many reports we have, all that kind of stuff. They could overhaul the whole system, but they aren't, and you just have to deal with the reality. And I just don't think people dealt with it very well this year. The numbers didn't quickly change on people. The only surprise, and it was a big one, and I lost money on it without a doubt, in my account and other guys that were counting on beans being somewhat tight this spring, was the B number from last year. The acreage and the yield looked like we were going to get awfully tight this spring. That was the only number that changed, but by February it was apparent that we weren't going to get tight in soybeans and things had changed. But that was the only curveball. Otherwise, these numbers had been bearish for a very long time.
And I think the thing to remember with that is, though they were bearish for a long time and the prices didn't change that much until the last few weeks, it's going to be the same thing even if the USDA is wrong. Even if there is not a single bushel of corn on a farm right now, that's not going to show in the price for the next couple months.
And it didn't in 2020 either, when the big bull market broke out and the numbers were completely wrong. I wish that would have never happened, because I think that's where a lot of the distrust comes from. That was a terrible thing. But what was different that year is China was buying nearly every day in the summer. They were buying beans and they started buying corn very aggressively as well. We're not seeing any of that. So it isn't going to be 2020 because they're not clearing out the commercial channels fast enough. But to your point, if it isn't out there, it will show up. I mean, and it will show up just like 2020. If there's none of this exists on the farm, like they say, you will get a very large bull market. But I don't know. It seems like if you do that every year with your marketing, I don't think you're going to do very well.
Right. Well, my point is there'll be signs before it moves. It won't be
absolutely
beautiful weather.
Yep.
I mean, we aren't seeing huge demand come in yet.
No, the local ethanol plant here is really bidding up corn. And it's like, well, is it not out there? Or is it just being in stubborn hands? I mean, we're soon going to find out. But what the guys holding corn know right now is that it won't be too long before there will be plentiful supplies, unless there's a frost or something, that we don't know about. And basis is going to erode on them maybe, or the thought of storing this crop and next year's crop probably is not really appealing with the price right now. So it feels like they want to squeeze these bushels out real cheap. And it's going to be a cat and mouse game here for the next 3 or 4 weeks, on whether we're going to puke these bushels at low prices or the guys storing are going to win in the end here. And in this little window, maybe get a nice little rally. Also, you have the funds that could just randomly start covering shorts for no reason. There's definitely reasons that could rally here. I'm talking corn. Beans still have a weather market to get through. Like August is when beans are made, so you can't get as bearish as you can maybe corn this time of year seasonally. Usually when it pollinates in good weather, corn gets to be pretty tough to hurt, where beans you can still hurt. So we'll see. I mean, it's they did it. The guys storing it did not win so far. They did store it into the teeth of the 2.1 billion bushel carryover, and now the price is down.
So if I'm storing corn and I didn't hedge, and now I'm sitting here looking at these prices, what do I do?
I laugh just because it's not a funny situation. It's actually that's a lot of phone calls still. I mean, you get a lot of these calls, and that's a bad sign. I mean, these aren't normal calls this time of year at all. What to do with the rest of the old crop, but very, very common call.
But can I sell a call on my corn? I mean,
it would be called
what are options?
It would be called a covered call. Yes. So you're covered by the bushels of corn in your bin or wherever it is, and then you're selling a call, but you're covered by your corn. So if it does go up, your corn's going to make money. The call will maybe lose money, maybe it'll break even, maybe even make a little if it only moves up 10 cents. It's somewhat unappealing because the premiums haven't been there. They have never been good to do that, but that would be a covered call strategy. There's guys that do that all the time, sell calls on stuff they're storing, generate income, always have income coming in. Stock guys do this. You have IBM, and I have no idea what the share price is. Let's just say $125. You sell a $140 call, and you're covered by your 100 shares, but if it doesn't get up there, you just keep collecting the premiums. It's a covered call strategy, very effective in corn. Beans, much more dangerous market to do that in, but corn, very effective. And that's maybe for another episode of what can you do now. And I did talk about that, about beans today to a client. Beans, a lot more risk involved there. The premiums have never been very good. But hey, if it got up to 460, would you sell it? Yes, is your answer. Why not just sell a call, collect that premium? You're going to sell it there anyway. It's a little more complicated than that. It involves margin calls and possibilities of margin calls, and it would have to be discussed. But, there's nothing wrong with selling calls and setting some sort of mental stop on where you'd be getting out of maybe a position. Let's say you sold a 460 call for 10 cents. I have no idea what it is. And it ended up being 15 cents, and the outlook kind of changed, and it looks like corn could go significantly higher. You're not obligated to that. You can get out anytime you want. So my advice is, if you do stuff like that, come up with a solid marketing plan on exits and entries and exits, and then know exactly what you're going to do if this happens, if this happens, and just plan it out. Which is what I did for a client today. So we have an exit strategy if it does something that we don't like it to do, but you're going to be making money on your bushels going higher. And my phone's ringing. This guy has called 4 times in a row now. It's probably a question I can answer later on. So sorry about the phone ringing. Anyway, so it's hedging is you're always learning. I think that guys are going to get a lot more interested in it, and this is usually the way it works. When your back's against the wall, you get open very quickly to a lot of new ideas. So hopefully, guys want to learn about it and want to. So I have a soft spot for guys that want to learn, because I don't feel like there's a lot of good information out there available. And I'd be happy to talk about any of this in length to anybody. And it's not like I sit here and say, after falls, I got this all figured out. All I'm saying is this market didn't do anything that it normally wouldn't do in any given year. It followed the seasonals, and it went right with the fundamentals and did something that was somewhat predictable this year. Last year, I don't think it was. This year, I do think it was.
So let's talk about a market that you probably couldn't hedge. Or maybe you're a genius and you got a hedge here, but let's talk about the move in cattle the last couple of weeks. Counter seasonal, significantly under cash.
Yep.
What do you do here?
It reminds me of 2014. It was chronically under cash on the way up. Like $6, $7, $8, $9 wasn't uncommon. It makes it unappealing to use the board to lock in that profit when you can get $9 more in the cash market. And that's what we're looking at in cattle here. Very unappealing board to hedge from. You have August $12 under the current cash at last time I looked, anyways. But it is the futures market. The futures are saying, hey, we got a big cash break coming here, and we're going to price it in right now. And that's what's kind of wacky about cattle hedging is you don't know what kind of attitude they're going to adopt. So you got a very positive basis in cattle right now. It's a cash seller's market. Bring your cattle to get good cash. That's how you win this market. If you're on the fence about selling cattle, this is a great price. The futures aren't going to protect you very well in the live cattle market. Now, where do we go from here? It's quite a standoff. I mean, the futures guys are betting the cash break seasonally is coming now. Are they going to be right? Are they going to be wrong? Well, they were right in 2014. Eventually, they were wrong for a very long time, keeping a discount. It did go a lot higher discounted. But eventually the discount was correct, and then it started the other way. So I was asked this question a few times today. I am looking for another surge to hopefully get hedges on, but I'm very interested in the next 6.5, 7 weeks to be getting stuff on. So I hope to be active. We just need a better board. I'm not happy with where the futures are.
So is there anything I can do when a market's when the basis is that much over cash? I mean, if this happened in any market, is there anything I can do to hedge or
go to the bar, grab a beer, and complain about it?
Okay.
That's what I would do. No, it gets to be more difficult. The best defense is to market your cattle if you're close or you're on that, if you're deciding whether I'm going to wait a week or 2 weeks or 3 weeks, you're better off selling in the cash market right now than you are waiting around. You have no way to protect yourself effectively with futures right now. So you're just you're vulnerable up here to the cash market coming down to meet the futures. When the market's inexact, there's planning, it's logistics. You can't just snap your fingers and get all your cattle to the sale barn. You have to plan it out. But, if you're contemplating it, yeah, it's a seller's market in the cash market, not in the futures. Where last year was the opposite. The futures, I think, were $6-7 ahead of cash in the summer. Oftentimes, it was an effective hedging tool, and then to see what the cattle market was going to do. So it's the opposite this year. It's just haul them to the sale bar and sell them if you're going to sell them. But I'm not saying if you didn't have those plans, you're going to hold them into next year, run and sell everything. I have no idea what the next year holds. It could be a wild bull market, but the futures aren't very helpful at these levels at all.
So, I mean, it's not unusual that prices, the shift in basis and a futures price, and it's hard to remember too, I think, for a lot of the people that I talk to, that this is a futures market.
Yeah, they're not. It's not a today market. It can be a today market.
Yeah,
and they can trade the news of today, but it's always looking forward. You look at some of the deferred contracts. April 189 something today. I think we topped out at 199.75 last year. It didn't quite hit $2. I remember that. So it's not like way off of last year's highs in some of the deferred contracts, but still, you're hedging a contract $5 under the current cash market. So we'll see how it all shapes up in cattle. Kind of a sloppy looking market right now in the futures market. I don't see a lot of opportunity. I'd be more looking for bull spreads that made sense, even though seasonally that doesn't work, by the way. That's what I would be looking for. I haven't looked at it too deeply the last couple of days, but I will. That's probably where I'm going to be, is in the bull spreads. If anything pops up, that looks good. But there might not be an opportunity there either.
Yeah. Now, hogs, on the other hand, they've been green every time I've looked for the last week. You mentioned you were
I think people will be angry with you saying they've been green about 3 days in the last 3 months.
They were the last 3 days I looked, they were green.
Yeah, the deferreds. I'm tracking some. I like some bull spreads there. Hogs are near and dear to my heart. The hog spreads. That's kind of how I built my business. Even there's some really consistent stuff back in the day. So I am looking at some of the deferred stuff. It has taken off in the back end. Maybe that's the trader saying it's too low back there. They don't know the future back there, and maybe it has looked better though. Without a doubt, the deferred stuff looks like it's on firm ground anyway. So hogs always an interesting market. I like to follow it every day, even if you don't raise hogs. Guys like that market. They talk about pork bellies all the time, and of course trading places in pork bellies. That contract doesn't exist anymore, but lean hogs are full of action for sure. And it's often brought up about with clients, that don't raise hogs. They just seem attracted to the hog market. It's not uncommon at all.
It's definitely a market that moves. So I think
that's why. Yep, that's why people like it.
If you have somebody who wants some action, it's a little more action than my pocketbook likes, but maybe the spreads are okay.
Hogs won't bore you oftentimes. No, it's gonna be moving.
No, it'll move. Although the options, hog options can be super tricky. There's times they pay, but
they can be great, and they can be they can be too expensive, and then they can be way underpriced, and you need to be on top of them. And following hogs to have effective, to be an effective hog trader, you have to pay attention to what's going on. And of course, that has a lot to do with the cash market index. That's, index over, I think, 5 days. And you're going to want to know where that is at all times. But once you get into it, it's a fun market.
That's great. Well, your phone keeps ringing.
It does.
I'm sure other people would love to have you ignore their calls too.
Yeah.
So how do they call so you can ignore their call?
Without a doubt, when I do call back right now,
yes,
there won't be anybody picking up because that's the way it works every time. Phone tag.
Well, why don't you leave your number and we'll wrap up and enjoy this beautiful summer day.
218-731-1578.
Thanks, John.
Yep, no problem. I don't know if I said my number right.